said third party. It's anything, I would say, non-tangible in terms of your professional services. So it's advice, it's consultancy, it's design. For a lot of people in this room, you know, I'm sure you're aware of this, but certainly for contractors, there's always going to be huge crossover between your public liability insurance and your professional indemnity insurance. We'll come on to that later on, but I think that's why actually, if you can, it's quite important to have professional indemnity insurance with the same insurer as, for instance, your public liability insurer or your other general liability insurers, just because it stops that bun fight from later on. So yeah, things like workmanship, for instance, or the physical acts of a contractor aren't insured under professional indemnity insurance because it's professional services only. It's mandatory for a lot of bodies, the SRA and ARB I've put in there, RICS. Again, interesting for contractors. The reason you buy it really is, of course, because you should, certainly if you are responsible for designers in the supply chain or you've got your own in-house design team, but actually it's the contracts you sign, right? It's those clients that are pushing you to carry professional indemnity insurance, and it's what you sign up to. I don't know why we chose Leaning Tower of Pisa, because I don't think technically it's a design issue. I think that's just years of it being there. If you've ever been, you'll see the American tourists doing the generic photo of holding it up. But why would a PI claim arise? Well, yes, it's an allegation of wrongdoing in the course of your professional services. It comes from design or specification, late delivery. There's so many things actually that whereby a PI claim could arise. I think certainly for contractors, and again, it depends on the type of contractor you are. Of course it does. But I think quite a common claim actually comes from the supply chain. So it's those that you are responsible for. The claim will often come against you in the first instance, and it might be that there's a designer or a professional consultant in that supply chain who is responsible for the claim, but actually you're the one holding the can. So I think that's quite a common one for contractors. And I think certainly in the built environment, in the construction sector, you never really know what the problem is and whose fault it is in the first instance. You'll just tend to get a letter of claim. And these things, of course, take a few years in order to resolve. So it's never quite that black and white. But yeah, these are some generic issues and problems that we see, and certainly whereby there is a professional indemnity insurance claim being made to insurers. So with that aside, and we've looked at what professional indemnity insurance is, we can get into sort of the bones of this. So we really talk about the market cycle now. You'll probably, I think, have heard this from your brokers or indeed from the insurers, but I think it is a very important point. Much like the economy, much like the world itself, it works on cycles, and it's almost like a boom and bust, if you will. In the professional indemnity insurance market, and indeed the insurance market as a whole, we have what we call hard and soft markets. So a soft market is whereby insurer capacity is high, there's a lot of competition for business. It's a good environment for a buyer because insurers will scrabble for your business. You'll find there's more competition. You'll probably get better terms and conditions in terms of the actual renewal of your policy. It usually, as it's kind of where we are now, or probably where we're going, it usually feeds into interest rates being at a high as well. It might not surprise you to learn that insurers make the most money from their investments. So when it comes to your premiums that you're paying to insurers, you'll find that those premiums are invested, basically. And when those premiums are invested, that's where insurers make the money. But of course, if interest rates are higher, they make more money, right? Insurers don't tend to be that profitable for most on the basis of, you know, every pound of premium that they earn, they will probably pay out 90 pence at least of that as a whole. For some insureds, it'll be a lot worse than that, actually. So again, they need that income from investments, and it does have a knock-on effect to premiums. The hard market is a more challenging place to be. We came to that, I think, in early 2018, I would say, partly brought about by Grenfell, but I think there's probably a lot of confusion actually as to why it happened. It's not just Grenfell, it was the Lloyd's report at the time, it was economic factors, COVID later had an impact on that. There was a variety of factors, but yes, it's a time whereby insurers become thinner on the ground, they aren't particularly profitable, which passes on to you, the insured, and how you buy your policies, and it ultimately means premiums are higher, cover is less, and insurers are a lot more stringent. And I think actually we found during that time that actually things take a lot longer as well, because unfortunately insurers seem to have all of the cards. So if you look at the conditions now, so where are we? So we are transitioning from a hard market to a soft market. Now, you can tell I've done this slide deck myself because I would have had a fancy animation had I got someone better than me to produce the PowerPoint presentation. But ultimately, that transition from a hard market to a soft market, we're somewhere in between that two. We're closer to a soft market. Again, depends on your renewal. It probably depends upon your own risk profile. But I think for a lot of people, we're probably already in a soft market, actually. We are beginning to see, and again, you know, on a very, very rare basis, I would say, premium reductions for some insureds, but we're certainly seeing for most, and the vast majority, I think, of our insureds, we are seeing rating decreases. When we talk about rate, I think that's quite important because your rate is basically, yes, the premium you pay divided ultimately by your professional income, which is a part of your turnover, multiplied by 100. And that's how we measure people's premiums. We measure it by rate. So if you get a rate reduction, you are paying less in the whole, which is obviously where we want to be going with all of this. Rating reductions, I think, of between 5-10%, even more, I think, for some insureds are becoming very common. I think we're finding whereby turnover is increasing or professional revenues are increasing, actually, yes, we're achieving some healthy rating decreases, I would say. At this stage, insurers are looking to retain premium, and it falls back to the point I made before about investment. So they still want the cash in the bank to be able to invest and to be able to make money back. So it's not necessarily in their interest just to increase your premium for the sake of it. They kind of want to stick with what they've got because they are aware that there is other competition in the market at the moment. We've had new insurers come into the professional indemnity insurance market, I would say, since 2021. Those insurers have now made a bit more of a strong foothold. You have certain carriers, you know, the likes of a Berkshire Hathaway, or an AWAC, certainly a Fortegra, that we've seen be quite punchy, I think, when it comes to professional indemnity insurance, be quite competitive on risks. So again, your holding insurer knows that, and it is something that they are always going to be wary of because they don't want to lose your business, and therefore they're going to want to keep hold of you where they can. So again, cash is king for them at the moment. I will touch on cladding and fire safety shortly, but part of the reason that we are moving to a softer market, in our view, is that a lot of the previously notified cladding and fire safety matters have crystallised. And I've used the word crystallised as opposed to settled because matters, of course, take a number of years to actually resonate and to eventually settle. But they have reached a point, I think, whereby insurers are aware to a large degree of what they're actually going to end up spending on some of these matters. We had a point in 2017, 2018, 2019, and you may have done it yourself if you have that exposure, whereby we had our insureds notify these cladding and fire safety matters, but there was always a bit of uncertainty. I think now insurers, they know what they're going to spend, they've budgeted for it, so realistically we're at a bit more of a stable position, and that just feeds into the market conditions that insurers are therefore a bit hungrier for business and a bit less cautious than they were before. For those that have read our more recent market updates for all things professional indemnity insurance, our tagline was there's a reason for cautious optimism. I think that's still true as the days go by, as we get further into 2024. there'll be more reason for optimism and not necessarily cautious optimism. I think it will change to optimism. Time will tell, of course, but we are certainly on the right track. And I do think for those buyers of professional indemnity insurance, it is a much better time compared to where we were in 2018. So what are we seeing? I touched on rating decreases for those with increased turnover. So again, if you're a growing business, unfortunately, yeah, you're probably in most cases going to find that your premium will increase in line with that. I think the aim would always be for a held premium whereby you are growing and therefore, you know, you're not paying any more, not additional exposure, but that can be tricky. Again, depends on your risk profile, dependent upon your own claims history. But yeah, we absolutely are seeing rating decreases for those with increased turnover and for those that are growing. We are seeing held premiums, I would say, for those with reducing turnover. Again, not always true. It depends upon the specific circumstances. We have had cases whereby insureds are really struggling and really feeling the pain, possibly because of supply chain or possibly because of cash flow issues. Look, you know, with the right broker, insurers are willing to help and willing to, you know, review premiums. There's different ways they can spin it in terms of whether it be rating off of a 3-year average, for instance, or whether it be looking at some sort of contingent rate for different parts of your overall turnover. Insurers are willing to help if you have that conversation. I think it's just important to keep the dialogue up and look at where you want to go. Premium reductions for the right risk. Well, what's the right risk? Yeah, okay, you know, those that are claims free. I'm sure a lot of the insureds in this room are claims free. And again, you've got a good bargaining power if that's the case. No one's saying that the premium will halve, unfortunately, but actually, again, when we talk about rates, that's the journey. It has to be, I think, looking at rates decreases where you can, certainly if you're growing. We are seeing competition, which I've touched upon. We are seeing increasing line sizes from insurers. So I think in 2018, we had a scenario whereby you might have one insurer writing, let's say 100% of a 5 million line on a primary layer. That got reduced to 50%, so 2.5 million in that primary is all that insurers would do. We're seeing that change now, perhaps less so within the primary layer. So for instance, that might be your first 5 million, but certainly when it comes to excess layers, so you're a 5 over 5 to make it to 10 or any layers above 10 million, we're seeing insurers be a bit keener to increase their line size and offer £5 million, for instance, above that limit in some cases, possibly more. Again, for the larger contractors where there's more exposure, realistically, yes, we would still expect to see more insurers on the placements. For some of those more, I don't want to use the word smaller, but perhaps those more SME type insureds, you might find that you have less insurers in that program. There's no right or wrong way to do it. I think in some ways you actually might be better off having more insurers on the program, because certainly what we learned in the hard market, and I think what we've always known, is that if you have more insurers on the program, it does give you more options if times get hard again, because those insurers are already familiar with you. They can drop down, for instance, to be primary. And again, it's about relationships. It's no bad thing to have a relationship with a number of different insurers. Something that is still very common, and I think now is becoming the norm, is this aggregate unlimited basis of cover. It used to be the case that contractors would be able to quite easily buy any one claim cover. And again, I'll come on to what that means in a second. In the current market, and again, I think this has been a symptom of the hard market, but it's something that is here to stay. We would suggest that aggregate plus unlimited reinstatement cover is very, very common in the professional indemnity insurance market for contractors. We've actually seen it spread to architects and engineers and other professions as well. It's a way that insurers are looking to place the professional indemnity insurance policies because it works better for them ultimately. And just feeding into that, there are basically 3 ways that you could structure the professional indemnity insurance policy. Number 1 is what I would say the most traditional way, which is any one claim. It's also called each and every claim because, yes, as insurance brokers and insurers, we like to use a range of terminology to describe the same thing, just to confuse people unnecessarily. But in that example, you will have a limit of indemnity for any one claim. So let's say you buy a 10 million limit of indemnity. You could have 100 claims in a year, and each claim you'd get up to £10 million for that. So effectively, you've got an overall unlimited limit of liability, but any one claim could not be any more than 10 million quid. Your second example is whereby you might have any one claim and any aggregate. So if we kind of ignore the any one claim statement, you would just have an aggregate limit. So you'd have £10 million to spend over the entire year. So in that same example, if you had, let's say, 10 claims totaling £10 million each, ultimately, you'd only get the first claim paid for. You'd only have £10 million in the aggregate, and then that would be done. Any claim after that would not be covered because you'd have blown your 10 million aggregate limit. So the third example is what I've just referenced there, which is a bit of an amalgamation of the both, but we call it any one claim and the aggregate plus unlimited round-the-clock reinstatements. We couldn't have thought of a catchier tagline, unfortunately. This is very common. You might find that you already have it. For those of you that don't, you might find that it's imposed upon you in your future. I think there's probably a lot of misunderstanding around it, and there's probably a lot of resistance and hesitance whereby insurers impose it, but it is just a different way of offering you any one claim cover. We've got a fancy diagram over the page. So again, don't worry too much about that. I'll try to explain it in layman's terms. Ultimately, you've still got what we would call an aggregate tower. So in this example, the insured is purchasing £10 million and it's split into 2 layers. You've got your primary £5 million, and then you've got your excess layer being £5 million in excess of that primary. Now, if we look at the chart to the far right hand side, that's your aggregate plus unlimited reinstatement model. Your claim will go up through the tower. So let's say, what have we done in this example? So yeah, in this example, we've got a £5 million claim as demonstrated on the right hand side. A £5 million claim will burn through the tower and effectively wipe out your primary £5 million of cover. Your second claim of £5 million will basically wipe out that top layer, thereby taking out your entire £10 million. Now, for any third claim that comes through, the tower will basically reinstate. So your 10 million tower will basically come back, and any next claim, you'll still have the £10 million available again. The reason that insurers like doing this is because, as opposed to the any one claim model, your insurer A on that slide, or whoever does your primary policy, will get hit each time for each and every claim on an each and every claim policy basis. And they don't necessarily want that because the excess layer insurers might never get hit. It's very rare that we see claims in excess of £5 million. I would say they're actually quite rare. So the bulk of the risk is always going to be within that primary layer. As far as insurers are concerned, then, if they have an aggregate plus unlimited reinstatement model, they're a bit safer on the primary because they know that their limit of liability in this example might be £5 million, and then there's a £5 million on top of that, and then that primary £5 million will come into operation again should there be another claim that burns through effectively. And so realistically, that's better for them because it means they're better protected and they take their chances, really, that there'll be that third claim in this example that would come through and burn through the bottom again. So it does mean for insureds that you can certify to your clients that you're carrying any one claim cover, or each and every claim cover, whatever you want to call it, which again is the most important thing. In terms of premiums, it is on the whole more economic than your any one claim model, because again, insurers appreciate that it's going up through the tower before reinstating back round. Just a word of warning on this, I would suggest that in a lot of cases, insurers will want you to buy at least £20 million in order to achieve the aggregate unlimited reinstatement model. And that's because they need enough ventilation for it to go all the way up through the tower before coming back round. Not always true. There are some insureds that we have that buy £10 million and on an aggregate unlimited reinstatement basis. Again, it's a case-by-case basis, depends on insurers, but it's something worth pushing for if you are looking to achieve that any one claim model, but you're being told by your insurers or your broker that you can't buy it. Yes, that's probably true. You can't buy any one claim cover for a contractor in some cases, but you can buy aggregate plus unlimited reinstatement cover to give you the benefit of any one claim cover, and thereby, speak to your clients about it. So do push that point if that's something that you're struggling with. We have, I think, in the last 2 years, seen contractors come to us and say, we're being told we can't buy any one claim cover. Yes, that may be true, but I think there is probably a misunderstanding around the aggregate plus unlimited reinstatement basis, which is definitely something for most people that you can buy. And the reason I say for most people, yes, let's face it, if you are, you have a very unfortunate claims record, it's possible that that's part of the reason. But I would say for the vast majority, aggregate unlimited cover is always available. So we said we'd touch upon cladding and fire safety cover. Excuse me, I just wanted to give a background. You are probably all aware, I think, that after Grenfell, insofar as professional indemnity insurance is concerned, there was a real knock-on effect, and we saw various iterations of exclusions and conditions and certain endorsements when it comes to cladding and fire safety. Caused a huge issue for a lot of our insureds who certainly had that liability. We ended up actually having a lot of what we would call block notifications. Insureds would ultimately block notify, so there might be 20, 30, 40 matters they would notify before the end of a policy renewal, because they know that insurers are going to impose more stringent terms with regards to cladding and fire safety at the renewal, and therefore they needed to get them out so they had full cover for them effectively. There was a few iterations of general clauses. You found different insurers doing different things, and it was all getting, I think, a bit complicated and a bit confusing, and actually quite dangerous. I think where insurers were looking to carve out cover or exclude cover, certainly with regards to fire safety, the language was quite broad. I think we had a situation on one of our insureds whereby, for instance, they had a fire on a metro station, so nothing to do with cladding, nothing to do with what insurers were trying to achieve here, the Grenfell scenario or another Grenfell scenario. And that fire safety term was just so vague and ambiguous that, to cite that example, things like a fire at a metro station, well, that's not what the intent was to exclude cover for, right? If that falls back to a professional design error, then it should still be covered under professional indemnity insurance. So we've been through probably quite a few years of a bit of confusion, realistically. In 2021, the IUA, so this is the International Underwriting Association, sought to provide conformity. They introduced a set of wordings that were a bit more commonplace for cladding and fire safety. The intent was that they would apply across the board, so across a range of insurers and across a range of insureds, with a view to just making it a bit more conformed in terms of who's got what cover. Now, there are actually three, to my mind, there might be more, there are actually three iterations of this endorsements, and there is a reason I'm sharing this with you. So you will find, and again, check your own policy or check with your broker, but you will find that you'll either have some sort of exclusion or restriction for cladding and fire safety cover, or you'll have, I won't say full cover for it, because I don't believe anyone's technically got full cover for cladding and fire safety if you have an exposure to it. I would say that this is the best that you're going to get in the current market. And again, that's why I share this. So this is the IUA version of the cladding and fire safety clause. Don't worry, I'm not going to go through this word by word with my Scouse accent, because otherwise we'll be here all day. But there are just a couple of key points to this. So basically, when it comes to cladding and fire safety claims, what insurers are saying is, per point 1, your cover is limited to direct loss, cost, expense and defence costs. So effectively, it's direct losses only, so consequential losses are excluded. A good example of that might be whereby, let's say there's a tower block and you have a shop that's in the tower block, and let's say they have to move out because you have to go back and rectify the cladding. The consequential losses might be that shop saying, well, hold on a minute, we've lost income for 3 weeks, which totals £100,000. That wouldn't be covered under your professional indemnity insurance policy, because consequential losses are excluded when it comes to cladding claims as a result of this particular clause. There was a definition of cladding and fire safety there, which you can see at the bottom. They've tried to make it a bit more prescriptive, which I think does work, again, compared to where we were previously. The other key here is that there will, in some cases, be a self-insured excess applicable to cladding and fire safety claims, which might be greater than what your annual excess is. And I think the third point to note, which is an important one, is that if you have a policy whereby you have defence costs in addition to your limits, in this case for the cladding and fire safety endorsement, you'll find that defence costs are inclusive. So it's a combined limit, if you will, and defence costs are within that overall limit. The reason we're talking about cladding and fire safety cover is because I would say where we are at the moment in terms of the market, in terms of market conditions, it is available. I think that there was a point whereby insurers probably shut the door on covering anything to do with cladding and fire safety cover if you didn't already have the cover. I think we've seen over the last couple of years that insurers are now open to that conversation. They will, of course, still ask you for information. So it might be a cladding and fire safety questionnaire. It might be just an overview upon what you do with regards to cladding and fire safety, what your procedures are. I think for those, ironically, for those that don't have any exposure to it, or would say that they don't have any exposure to it, I'm thinking maybe more like a civils contractor, you will likely find that insurers are a bit more open to having a conversation because you're not going to have an exposure to cladding, right? Okay, fire safety, again, is probably, I think everyone's got exposure, or most insurers have got exposure to fire safety, in my view. Piling contractors, again, question mark over that, but yeah, I think you're more likely to get the cover. But why do you want the cover if you don't have an exposure? Well, again, I would say in this market, it's time to push for as much cover as you can. And I think also we are finding now that end clients, so your employers, will not only ask you for a verification of insurance letter, but will also ask you about the cover that you have within that. So it might be things like asbestos, pollution and contamination, but we are seeing cladding and fire safety come to the fore in that regard as well. And so those questions you might find, being appointed on certain projects easier if you've got the cover. So again, we would suggest, for the most part, this is the broadest cover you will get for cladding and fire safety. It's definitely available, so definitely have the conversation. If you have it excluded at the moment, or you have any other sort of provision or term, it might be insurer driven. Of course, different risks or different insureds are treated slightly differently. That's just the way it is. Those that have had an exposure to cladding and fire safety and have claims won't necessarily be able to buy this cover. But again, the point I'm making is it's worth having the conversation if you need it, because it is certainly there and insurers are willing to look at that. So we said we'd cover the impact of new legislation, and I will get my disclaimer out nice and early and say that we aren't solicitors. Of course we're not. We can only talk about this from the perspective of professional indemnity insurance and what it means to you. The Building Safety Act came into play in 2022. It had been coming for some time, of course, I think, as we all know, but it did introduce and has introduced a couple of interesting quirks. Notably, we think the principal designer and principal contractor role. Just realised there's a typo there. That's very sloppy, is it? Principal contractor role. Apologies. Which does create concerns, I think, for design professionals and for insureds. There's certainly the principal contractor role. We've had a few questions from insureds as to do we really want to step into those shoes. I would say the answer from your PI policy is you're still, unless it's specifically excluded, which I would say it's not going to be in most cases, you're still covered for those roles. Yes, it's an additional liability and indeed an additional responsibility as far as you're concerned. Insurers are aware of the roles, and again, we haven't at this stage seen them impose any restrictive terms. We've not seen them kick up a fuss in any way about the new roles imposed under the BSA, but time will tell. I think if and when we see more claims or circumstances emanate from the new principal designer or the principal contractor roles, then actually then insurers will look at it more. Insurers are notably reactive as opposed to proactive when it comes to these things, and they always have been. So that may come out in a wash if there are claims in the future. The Defective Premises Act, again, that remains to be seen, but that was quite a change from ultimately the liability period, whereby you now have a 30-year retrospective timeline ultimately, which changes things hugely, right? I mean, who really has all the records of things that they did 30 years ago? It could be quite tricky, but again, we haven't seen at this stage any major notifications or claims whereby someone's citing the Defective Premises Act, but I think with it being quite new, that could certainly still come. The key point there is at the end, yeah, the full ramifications of the BSA and DPA are not yet apparent. As I say, insurers are reactive. We might find in the next few years, as more claims come down the line, that actually that changes. But for now, we don't have any major concerns from the PI perspective, but I do think from the insured's perspective, whereby you're taking on those roles, no doubt there's an additional liability, and certainly the Defective Premises Act does increase the chance for a claim, but you can't do anything about that. That is what it is. So here's the crux of the matter. So how you can get the best results at renewal. It's not rocket science. I think a lot of these things are actually pretty straightforward. I do appreciate, I think, that every insured probably in this room has had issues at renewal, and that might be increased premiums, reduced cover, things running too close to the wire. They are a lot of things that ultimately were brought by the hard market. There's no doubt about that. But again, as things are starting to change, it should become more straightforward, easier, and actually you should get better results for the most part. As I said before, huge caveat here in that, you know, please don't come to us afterwards and say, can you halve my premium? The answer is probably no. But again, when we look at rate reductions, when we look at timing, when we look at coverage, you know, there are certainly a lot of other things I would say that we can do, and I think we are achieving for our insured. So the key one really is, yeah, getting the renewal info early. Of course, it depends on when your broker invites the renewal, gives you the information that you need to complete. But in most cases, you'll have a proposal form. But actually, what about the supplemental information? So we talk there about limiting liabilities in contract, exclude any con losses. What about financial caps that you apply in contracts with your clients? Insurers love to hear all that. It's all about risk management. If you can make the case as to why you're such a good risk, and again, do it ideally, have all your stuff in, ideally, I would say 6 weeks before renewal. Probably any more than 6 weeks, insurers are probably not going to look at it, but I would say 6 weeks is that timeline, is that ideal sweet spot. Within that as well, and I think before you submit the renewal information, you will just be highlighting the aims and objectives with your broker. Yeah, obviously for everyone, ultimately it's the best deal, right? So it's the cheapest premium and the most cover. There's no shame in that. That is the aim for everybody. But I just think it's worth highlighting, for instance, if you want to make a play for fire cladding and fire safety cover this year, you need to say, you know, do you want us to remarket it? Do you want to look at the self-insured excess? Are there other elements of your policy wording that you're concerned about? I don't think it's necessarily a good idea to go all in with those things. I would say you're better off focusing upon certain things that you want improved. A marketing exercise, you know, is a way to achieve some of those aims in the same breath ultimately by approaching different insurers. You'll probably get a different policy wording, and then the cover feeds into that. But again, worth having that conversation with your broker, and we would always suggest meeting with your insurer if you can, whether it be on a Teams call, whether it be a lunch, depending on location. If they hold you other liability insurances, so your EL, PL, etc., actually you have a bit of bargaining power as well. But insurers are underwriters, they're just people like you and me, so therefore if you can get to sit down with them and just make them see it from your perspective, it's always worth doing. You are getting questions at the moment, I think, about supply chains again as interest rates are increasing. Insurers are concerned in the contracting world that your supply chain may be at risk, and therefore they will be holding the can for any potential PI claim that might be made in the future. So again, always worth doing a bit of due diligence on that and just explaining to the insurer how you operate in terms of how you monitor the firms that are below you, how you collect insurance certificates from them and the like, and actually just check that they're in good financial repute. The other thing, of course, is claims. They happen, it's why you buy professional indemnity insurance, that's fine. If you haven't already, on your claims summary, and if you have had claims, I say, if you haven't already, it's worth just having a bit of a summary as to this is why it happened and these are the steps we've taken to make sure that particular type of claim won't happen again. There's always a story, of course there is, and every situation is so unique, and it's just being able to paint that picture to insurers. Well, why do you want to take us on? Why are we a good risk? Well, yes, we've had a claim, but the point is we notified it, we let you know about it, we dealt with you cooperatively, and these are the steps we've taken to make sure it won't happen again. Insurers expect that everyone will have a bump, that's why you pay the premium, that's kind of the point of all of this. But again, it's just being able to really set your case forward in terms of why it is that you are a good risk and why it is that they should underwrite you. So I think this is the final slide, you'll be pleased to hear, and it's just a looking ahead, really, crystal ball gazing. No one knows what the future's going to hold. You won't be surprised to learn. But ultimately, I think things are moving in the right direction. I suspect that in 2 or 3 years' time, the market will continue to get softer. The rating decreases will be greater. I think you'll see more insurers come into the market. The Building Safety Act, Defective Premises Act might affect that, but at this stage there isn't any evidence to suggest. I do think if interest rates remain static or indeed even increase, you'll have that greater buy-in. I think there is a word of warning here, and it's just the way it goes. I mentioned before the hard and soft market cycle. The hard market will be back. Let's not pretend it won't. It might be 10, it might be 15 years, who knows, but when we drive prices down with insurers and we get more and more cover, that we're basically stepping towards that hard market, because eventually there's going to come a point where things are too cheap and insurers need to adjust the rates again, and you get that dramatic overnight turn. But yeah, for the moment, we don't worry about tomorrow, do we? So, therefore it is what it is at the moment. And I think, yeah, there are certainly some good deals to be had out there, and certainly much improvement from where we were in 2018 to 2020. So thank you very much for listening. I think we only got 10 minutes left. Oh no, 15 minutes left. So yeah, we'll open the floor to questions. If anyone wants to shout anything, please do.
Hi David. My name's Steve O'Donnell. I'm from Forkers Limited in West Brom.
Hi Steve.
I've just got a question about suppliers and subcontractors PI cover, and how we should be monitoring that. Our insurers are always reminding us that that if our subcontractors don't have the correct PI cover in place, then it will make our own PI cover. It will invalidate it. Basically, it will invalidate our own PI cover. And when we speak to our subcontractors about this, we get the same message from so many of them, stating that we are the only firm that they work for that ask for this, that are insisting that we are insisting that our subcontractors who provide us with professional services have at least 2 million of their PI cover. I was just wondering, is that the industry norm?
So it sounds to me, Steve, in your professional indemnity insurance policy, do you have some sort of warranty that requires your subcontractors to carry at least £2 million?
Yes, that's correct. If they provide professional activities, then yes.
Right. So I would say, is it the norm? No. I would say that insurers would ask you and like you to ensure that your subbies are carrying, or your professional services subbies are carrying, yeah, probably at least £2 million. But I think it goes back to the policy. I think within your PI policy, you probably need to push your broker / insurer to remove that condition. So making things a condition of the policy to respond is a very dangerous thing to do in our view, because as you say, well, actually you need to make sure that all your supply chain are carrying the 2 million. A lot of them might be very small traders. They might not be able to, well, they might not be able to afford to buy 2 million. What if they go bust, etc., etc. I would say that having a condition in your policy for subcontractors to carry 2 million PI is unfair on you, because it's a condition. We would always avoid conditions, and I would think it would go the other way around when it comes to renewal. You know, you would say to your insurer, this is how we manage our risk, we manage our supply chain. You know, we require people in our T's and C's, let's say, to carry 2 million quid where we can, and insurers kind of take it on trust. So I would say it goes back to the policy. I don't think it should be a condition, and I wouldn't say it is the norm. I understand probably, I think, why your subcontractors might get therefore frustrated with you. But I mean, so are you talking about, when you say subcontractors, insurers aren't asking you, are they asking everybody you appoint to carry 2 million, or is it just those with a professional?
Anyone providing us with professional services or professional activities. And
Right, okay.
they've broken it down to us as being either design or specification, supervision of construction, feasibility studies, technical information calculation, or surveying.
Right, okay. I would say it's the condition that is unfair, and I think that needs to go. Personally, I would say, because yeah, I would say it probably used to. I think perhaps certainly when so I've been doing this for 15 years. I think when I started, it used to be quite common. You used to have a subcontractor warranty, and yeah, you would warrant that all your subbies basically carry 2 million. I would say now you would push on that, and I would say it shouldn't be a warranty or a condition of your policy. Yes, again, you know, insurers, I think, would like you to impose that where you can, and like you to, you know, monitor your own supply chain. But I think there's a difference between taking it on trust, which I think is where you should be, as opposed to having a condition in your policy. So yes, I would say that's slightly unusual, and I would say that I think that's something that your broker / insurer needs to look at, because yeah, that does strike me as slightly unfair.
Thank you, David.
Can I just interject and tell you that you're not the only person that has that condition, because we have almost exactly the same wording on ours and have had it for several years.
Is that Andrew? Yeah. So
From
I think it's out there. I mean, can I ask, Andrew, your policy wording, is it an insurer-based policy wording? Is it like badged, for instance, with, I don't know, a CNA or an AIG or someone?
I can't, somebody like that. I can't remember them. I can tell you they are if you need to know.
No, go ahead. The reason I say is because I think sometimes when it comes from an insurer, an insurer's policy wording as opposed to a broker's policy wording, yeah, you might find those conditions, but
yeah,
I would say, or I think we would say, that they are unfair, and we would always resist any conditions of the policy to respond.
We've tried so, and they're just not having it. Or the question is, we can remove it, but we'll increase your premiums correspondingly. So we do it and demonstrated our monitoring systems to them through various ways to reduce costs.
Yeah.
So you can get it removed, but you tend to pay for the privilege. I think that's certainly my experience of it.
Well, I mean, what do you have like a list of the subcontractors you use, presumably?
Yeah. Yeah.
And do you appoint them? Or do you tend to appoint them on your own T's and C's, or do you have a back-to-back basis?
It depends on the nature of the work.
Okay. I would say it shouldn't be. I realize I hear where you're coming from, and again, I think that there's probably a bit of an arrogance amongst insurers, which is a bit of a hangover from the hard market. But I would say that there shouldn't be an additional premium. I realise that insurers might chance their arm, but again, I think that, to the point on the last slide, I think your aim at renewal, if that's a concern, is we don't want an additional premium for subcontractor condition / warranty in the policy, because I would suggest that that's just a condition of cover. It shouldn't be that insurers say, oh, well, we're going to charge you an extra 10 or whatever it may be grand to take this out, because it should be the way around. If you can say, and that's why I say, actually a call with insurers might be quite useful in your case. If you can say to insurers, this is how we manage it. Yep, it's on a case-by-case basis in terms of how we appoint them. And again, insurers want to hear, and I think that's good risk management, right? That, they want to hear that you do impose where you can them to carry, 2 million PI, and you might ask for the verification of insurance before they are appointed. But so therefore, can you remove this condition? Because again, I think it being a condition of your policy to respond just doesn't work, and it's very unfair, I would say. Yes, I think it used to be there, but I would say that we've been relatively successful in removing conditions, subcontractor conditions in the policy. For me, that's an open conversation with the insurer, and I would say that you probably want to, if you can, speak to the insurer direct about it. With that information and with what you've got in terms of your own risk management procedures, in terms of how you manage your own supply chain. I know it's, we are a broker, right? So I do realise this is probably always a bit of us in the shop window, but I do think that those conditions are unfair, and I would say it's gonna. I'm not naming names here, but there are certain insurers probably that you're going to have more of a battle with. And I think there are certain insurers that are going to be a bit more lenient, but it depends on the wording. And I would say if you can get to a broker's wording as opposed to insurer wording, then you wouldn't have a condition anyway. But I definitely think that there is an argument to be had there, and it shouldn't be that they impose an additional premium. I can tell I've set myself up for a fall there, haven't I, Andrew? When you when you tell me that didn't happen at renewal, but yeah, look, it's worth having.
No, it's fine. I've had it checked by several people over the years, and they've all come back with the same wording.
Right.
It is on my hit list for this year. To be fair, because I've never been happy about it, and I raise it at renewal on an annual basis, and always get the same response. And I have had conversations with the brokers and with the insurers, but it becomes very difficult when you've got multiple layers, and different firms, because one of the restrictions is that the secondary layer will want at least the equivalent terms to the primary layer.
Yeah.
So your primary tends to be the one who insists on it, and your secondary tends to follow it.
Yeah, because it's follow form. I mean, if you drop me a note afterwards, we're happy to do a sort of an independent silent review. I don't know if we've spoken to you before, but I think we can tell you sort of honestly. I mean, I don't want to sort of say on here, I think which insurers are going to be more stringent with that, but yeah, happy to certainly have a chat about it. Yeah, I definitely do think that there is a way to remove it, I would say.
Okay. Thank you.
I think if I can use, so did we have a hand up from Paul? Yeah.
Hi, David.
Hello.
I'm Paul Santa from Seeker Southwest. I represent contractors in the Southwest region. First of all, thank you for a really, really good, informative presentation. And I was really pleased to hear you say, and I think I'm right in saying this, that the prognosis is cautious optimism. That's what you said, isn't it? Just a point of clarification, if I may, I'd also written down currently transitioning into a soft market, which seems to contradict that cautious optimism. Have I got the wrong end of the stick here? Can you just
not at all.
clarify that?
So I would say we were in a hard market from 2018 probably to 2020. I think we've seen things improve from 2021. And I say we're transitioning into a soft market because I would say the true sort of soft market probably is you probably are seeing premium reductions as well as rate reductions and insurers really scrambling over your business. So I would say, and the reason I say cautious optimism is because, we're transitioning to a soft market, but we'd be cautiously optimistic that we'll be in a full soft market in the next sort of 2 or 3 years. So I think there's better renewal periods actually ahead of us, I would say. And I'm gonna, if there were insurers on this call, they would shoot me down, I'm sure. But I do think that's true. I think the signs are we are moving towards there. So yeah, you're right to flag it, Paul. It's I think at this stage we would flag cautious optimism, but I would say day by day we are removing the cautiousness of our optimism. But certainly we're in the harder part of a soft market.
Okay, I've got it. I've got it. Okay, understood. It just seems to me that contractors have been saying to me, the premiums have been just going up and up and up. I haven't heard good news really from my members, but that's good to know that, just around the corner things will hopefully ease a little bit. And I just really wanted to, a point of observation really, I just wanted to say, I think it was that penultimate slide you put up is really, really useful because I've been told many times that the thing to do to try and keep your premiums down as much as possible is to have a really good relationship with your broker and your insurance company. You said about having a relationship with a number of insurers, which is also good. So you've got a little bit of flexibility there. But some of those points about getting your renewal information in early and stuff like that, I thought that was a really important slide. And I hope people on the call will look again at that slide and follow through. But yeah, that was it, an observation and just a bit of clarification. But thank you very much for your time, and I really enjoyed it, learned a lot.
Good.
Cheers.
Well, thank you, Paul. Thank you.
Thank you.
I think, conscious of time, I think did Kevin, I think was the only other hand up.
Yeah, hi David. I'll make this very quick. I was just obviously just wanting to maybe give some advice to the previous two guys there in respect of the supply chain, and it probably picks up on the ending that Paul just gave there in terms of that slide. I'm the insurance manager for Graham. We had the same issues with conditions in respect of the supply chain, and probably as a result of the hard market, a change in approach in our renewal, whereby I utilized our broker to actually set up face-to-face meetings. It was almost going into a room with upwards of 10 to 12 PI underwriters, and sitting down with those people and just explaining our business better and explaining some of the internal risk processes we had and building up that relationship, but also just reassuring them that we actually had a lot of checks and balances in place, and we weren't just doing things on a wing, and we found then we got the flexibility needed.
Yeah, I think that's.
Sorry, I see you getting evicted there.
Bear with me. Yeah, exactly. I think that's it. I think it's a dialogue, isn't it? I think it's an open dialogue.
It's by no means taking away the important role of the broker, but I just found that once you actually facilitated your broker to, or enabled your broker to facilitate those face-to-face and sitting down with names that were otherwise just names, and having that relationship and letting them ask direct questions and things that might cause them concern, and having answers to those or getting answers shortly thereafter, they were a lot more flexible on those conditions. They became conditions small c, where you could refer the odd one or two of them because of maybe a contract subcontract value package. If it was small chips, they would be flexible on that, but you were keeping them in the know and you built up that relationship. And oftentimes now when we have a little bit of concern, it's an email and a quick response to give the thumbs up and we're good to go.
Yeah, I think that's it, Kevin, and it's good that you've had that conversation with the insurers and via the broker. But no, absolutely, and I think there are, as you said, there are ways and means around it. All insurers want to hear is about your risk management. I do think, and I don't know if that was your experience, Kevin or Steve. Sometimes those conditions are imposed because of a specific scenario. So it might be you've had a claim previously as a result of a subby. Again, if that's the case, then that should form part of the conversation. To my point before around claims, you've got to, I think, be able to justify that. Well, this is why it won't happen again. So again, every risk is different, but absolutely, it's an open dialogue, and I don't think we can bang that drum enough in terms of having that conversation with insurers to remove some of those conditions.
Well, by actually sitting down with the insurers, you're inviting them to say to you as a business, okay, what is your reasoning for these conditions? And you actually find that oftentimes they've just come over from previous policy wording and they've just gone in as standard, but there may be particular things, maybe supply chain management, and then you show them the internal processes of supply chain management and portals and internal checks and balances that you have, and all of a sudden then they're going out of the room. There's still going to be some underwriters who are still cautiously aware, and they may not be as hungry for your business, but it certainly weeds out those that are from those that aren't. And generally I find that the majority leave a lot more satisfied with the risk.
Absolutely, Kevin. Yeah, absolutely. Yeah, and I think that's so important, isn't it? Yeah, absolutely. As I said, the underwriters are humans and they are willing to listen to you.